Chapter 4, it's a very good chapter. It's about cash and internal control. And it will talk about what is cash and cash equivalents. How do you provide a control on your cash? The bank reconciliation is one of those good internal controls. So you can, on a monthly basis, you can look at your bank statement to see what was in, what was out, and every single transaction has been accounted for. Doing bank reconciliation, it helps to reduce also the employee, let's say, fraud. Okay, so let's go and do some exercise. Exercise 5.9. Okay, 5, let's say start with 5 and then 9. And then 10. Okay. So here is exercise 5. It says below are several amounts reported at the end of the year. We have some currency, some supplies, short-term investment, accounts receivable, saving account, some undeposited funds, $650. We have some assets, current assets like prepaid rent, some coins, and some fixed asset like equipment and checking account. Calculate the amount of cash to report in the balance sheet. So out of all this information, you need to know when you are looking in the balance sheet and you see it's showing cash, what type of cash exactly is in there. So here is the list of information data, and here is exercise 5. We have some currency, 1,050. We have short-term investment that matures within 3 months. That's 1,950. Those things that short-term investment that will have a maturity date of 3 months or less, they will be considered as cash. They are very much liquid. 3 months or less maturity, it will be considered as cash equivalent. Balance in the saving account, yes, that's a cash. Check received from customers but not deposited, that will be considered as liquid. Coins, obviously, is cash. Balance in checking account, yes, that's also cash. So combined in the balance sheet, you will see $18,460, which you call it cash or cash equivalent. Okay, let's look at the exercise 9, for example. It might be also in your homework, right? So the company, General Ledger, shows a checking account of $22,970 on July 31st of 2021. The July cash receipts of $1,885 included in the General Ledger balance are placed in the night depository at the bank on July 31st and processed by the bank on August 1st. So we call this deposit in transit. Deposit in transit, that means a deposit that you record the transaction, you deposit that already, but the day of deposit was on the last day of the month, after hours, and that means your bank still is not updated for that transaction. It will get updated on August 1st, but that's already next month. So in the bank statement, you will not see such a deposit, and we call it deposit in transit. You did your bookkeeping properly. So it's not about your bookkeeping, but it is about bank statement that is not showing such a deposit. The bank statement dated July 31st shows bank service fee of $55. That's a debit memo. Debit memo, that means the bank debited your account by $55. Remember, your account, it's a liability for the bank. It's a credit, normal credit side balance. It's a liability for the bank. Liability has a normal credit side balance, right? But when they wanna deduct money from your account, like $55, they debit it. Moment they debit it, they call it debit memo. And that's how they call it. It's a debit memo. So debit memo, it's a bad news for you as a company because you know they debited your account and you will have less money because of that. The bank processes all checks written by the company by July 31st and lists them on the bank statement, except one for check totaling 1460. That is a outstanding check. Outstanding check, it's a check that you wrote it, you recorded it, so everything is fine. However, it's not cleared in your bank yet. It's still outside. You call it outstanding check. So momentarily what you do with that, you just deduct that outstanding check from your bank statement yourself, because you know eventually in a matter of days, it will be deducted. And just to reflect that in your bank statement balance, you will deduct it from your bank. The bank statement shows balance of $22,490, which is much different than your checking account balance that you have over there. Prepare a bank reconciliation to calculate the correct ending balance of cash on July 31st, 2021, and record the necessary entries to adjust the balance for cash. Okay, so let's see how we do that. That's exercise 9, I believe, right? So here is the bank reconciliation. Company name goes at the top, bank reconciliation in the middle, and the date after that. Bank cash balance will be, let's say, on the left side, and company cash balance will be on the right side. Or you can write it below each other, doesn't matter. And you start with the bank statement that says you have $22,490, and then you, on the other side, you start with the cash balance that shows in your T account that you have $22,970. Then you add, deduct, and add, deduct. So what you add, let's say in this example, you add deposit outstanding to your cash balance because those are deposit that bank balance. You add deposit outstanding to the bank balance because you deposit that at the last day of the month. You did the recording, but your bank is not showing such a deposit because it was after hours on the last day of the month. Also, you have a check that you properly wrote, recorded it, but the bank is not showing such a check has been cleared. So you're still showing is such a check as outstanding. So that's a minus. In regards to what you add in cash balance, it might be something like service fee. So if there is a bank service fee, I mean, if there is any automatic deposit, you will add it. If a customer does automatic deposit into your account, that's something that you didn't know till you get the bank statement. That's an add. But what you deduct, something like service fee. Service fee is a deduction because it's a debit memo in your bank statement. A debit memo, it's a bad news. That means they debited your account in the bank. And that's a $55 in this scenario. Bank service fee. Sometimes you have credit memo. Credit memo, it's a good news because normal balance in the bank for your account is credit. It's a liability for the bank, right? So it's a credit. But if they credit your account, that means now they owe you more. That means someone deposit a money for some reason and they owe you more money. Let's say if they give you $2 of interest income, that $2 of interest income will be added to your cash balance. It's a credit memo. Okay, anyway, so the only thing that is on the cash balance part for your company's cash balance needs to be recorded, either addition or deduction. So in this case, it's a deduction. So your service fee will be debited to increase the expense, and cash will be deducted by doing a credit to recognize that expense that has been debited from your account. You're good? Okay, if there is no question, then I will continue. Let's do one more. Let's say number 10. Okay, so here's the problem. On August 31st of 2021, the general ledger of the company shows a balance for cash $7,944. Okay, so that's your cash balance. Cash receipts yet to be deposited into the checking account totaled $3,338, and checks written by the company but not yet processed by the bank total $1,425. The company's balance of cash does not reflect a bank service fee of $35. That's a debit memo in the bank statement. And interest earned, that's a credit memo in the bank statement of $46. So the bank statement shows a debit memo, $35, and the credit memo of $46 for the interest earned. These amounts are included in the balance of cash of $6,042 reported on the bank statement. Prepare a bank reconciliation to calculate the correct ending balance of cash on August 31st and record the necessary entries to adjust the balance for cash. So it looks like this cash receipts yet to be deposited into checking account $3,338. So that's not yet deposited. So remember that. That's not deposited yet. It's in the company cash receipts, but it's not deposited. So that's fine. Keep that in mind. It's not deposited. So here we have let me read the question one more time. The general ledger of Dean Accounting shows a balance for cash $7,000. Cash receipts yet to be deposited into the checking account. This is deposited, but the bank is not showing such a deposit. Why that happens? Because if you deposit any amount, specifically on the last day of the month, and after hours, let's say in safe deposit box or in ATM machine, the system in the bank is not updated yet. That's why it says yet to be deposited in the checking account by bank, right? By bank. And also there is a outstanding check of $1,425. Outstanding check, because check is written by the company but not processed by the bank. So that is deposited into, let's say, ATM machine, is not updated by the bank, is not showing in the bank statement, and that is also outstanding check that is not showing in the bank statement. Okay, so we got that idea. Now the bank statement says that you have $6,042, but your book statement says no, you have $7,944. But we know there is a deposit outstanding that we did the deposit, we did the recording, but the bank is not showing because it was on the last day of the month after hours. So we manually add it in here to your bank balance. That's an add. For deduction, we have outstanding checks of $1,425, and that's again what we deducted from your bank because not cleared yet from your bank. In regards to it's like deduction, we have a service fee, which I'm gonna mute everyone so we have less noise here. Okay, so service fee has it's a debit memo in your bank statement showing, and those are things that you didn't know about it till you see the debit memo in the bank statement, and you see, oh, okay, there's $35 service fee, so I'm gonna recognize that and deduct it from my book, company's cash balance. Interest earned, that's a credit memo in the bank statement. You didn't know about it till you see the bank statement. You say, oh, I got another $46 for interest. That's good. So I'm going to add it to my company's cash balance. So again, there's an add section, there's a deduction. Add section and the deduction. So both sides of your bank reconciliation for the bank balance and for the company's cash balance, you have add and deduction. After all those add and deductions has been recognized, you do the math, and it should be equal at the end, and that's how you finalize your bank reconciliation. That means every dollar has been accounted for. In regards to whatever is on your company's cash balance section, you need to do an adjusting entry. So here we have an adjusting entry for the first one, service fee. Let's say here, service fee expense, that's a $35 expense that you need to recognize, or you can call it miscellaneous expense or bank service fee expense. That's fine, either way, debit. And then cash will be credited to reduce the cash. Okay, and also you have to recognize the interest that you earned. So cash needs to be increased by $46. That's a debit. And interest revenue needs to be recognized, and you increase your revenue by $46. That's a credit. So anything on the company's cash balance should be recognized as a form of journal entry. Since we are doing it, let's do one more problem. How about that? It's in your homework anyway. So let's go to exercise 11. In this one, it says on October 31st of 2021, company general ledger shows a checking account balance of $8,397. So you put that under company's checking balance, cash balance, $8,397. The company's cash receipts for the month total $47,320, of which $71,295 has been deposited in the bank. So you have the company's cash receipts for a total of $74,320, of which $71,295 has been deposited in the bank. So the difference is not showing, the difference of 74 minus 71. In addition, the company has written checks for $72,467, of which $70,982 has been processed by the bank. That means the difference is outstanding checks is not processed by the bank. So 72 minus 70, it's outstanding checks. The bank statement reveals an ending balance of $11,727. So that's where you start your bank reconciliation for the bank balance, $11,727, and includes the following items not yet recorded by the company: bank service fee of $150, a note receivable collected by bank of $5,000, and interest earned on that account balance plus from the note of $320. So collection is $5,000 plus $320 note, $320 interest on note. After closing inspection, Damon realizes that the bank incorrectly charged the company's account $300 for an automatic withdrawal that should have been charged to another customer's account. So it's a bank mistake, okay? Normally, bank mistake is very rare. It's not going to happen, but once in a thousand, it might, right? So here is the bank mistake. Prepare a bank reconciliation to calculate the correct ending balance of cash and also do the adjusting journal entry for the bank reconciliation. Okay, so we have to do that math over here to understand what is the difference for outstanding checks and for cash receipts that is not showing that is deposit on transit or deposit in transit. Okay. So here's the company name at the top, bank reconciliation, name of the report in the middle, and proper date. And then you have section left side and right side. On the left side, you have bank balance. On the right side, you have company's balance. Bank balance says you have 11,727, starts with the dollar sign, and your company balance says you have 8,397, starts with the dollar sign. And then you have add, deduct, add, deduct. Okay, what do you add? You have a deposit outstanding of 3,025. Deposit outstanding 3,025 is coming from here. The company cash receipts for the month total 74,320, of which 71,295 has been deposited in the bank. That means the difference of these two is not showing in the bank statement as a form of deposit. And the reason it might be because they deposit that amount at the last day of the month after hours, and it's not reflected in the bank system. That's why it's a deposit on transit. The company has done the bookkeeping for that. So there is no issue with the company's balance, but the bank is not showing. So that's where the 3,025 is coming. You show as a deposit outstanding. And in regards to check outstanding is 1485, and that's coming from here. 72,467 written checks, of which only 70,982 is cleared. The rest is not. So it's outstanding checks. So it's outstanding checks right there, 1485. And also you call bank and you remind them about the mistake they did, and they will investigate, and eventually they will deposit that amount back to your account. So that will be manually for now, just add it to your bank cash balance and note it with bank error. Anyway, add them up, you get 13,567. Now you go to the company's cash balance and you see that there is a credit memo of $5,000 note collection. So record that. Interest earned on that note, that's also additional collection, that's 320. And also you see a deduction, it's a debit memo of bank service fee of $150. So deduct that, and eventually you will see that you have a balance of 13,567, double line dollar sign, and it matching with the other side. Now, whatever is in here, you need to journalize it on your cash balance, company's cash balance. So you have to record that the principal has been reduced of that note receivable. So note receivable will be credited to record the reduction on the principal of the note that someone owes you. You will also record $320 of interest revenue. That's a credit, normal balance for any revenue. And you record the $5,320 of cash that is showing in the bank statement. So that's good. The next one is $150. So that's a bank service fee of $150 that you need to recognize. That's a debit. bank service fee expense or miscellaneous expense, and cash credit $150 to show the reduction in the balance of your cash. And that's the bank reconciliation. So we did few of those today. You have few more homework problems, but you got the idea, hopefully. I have also my lecture recorded on the PowerPoint. If you want to download that, it will be a little bit larger file, but at least my recorded lecture is on it. If you like the PowerPoint without lecture, just download that PowerPoint without and go all the way to exercise 20. This is exercise 20. Okay. So the cash is 12,000, supplies 8,000, land 60, deferred revenue 5, common stock 50, retained earning 25. During 2021, the company had the following transactions. So they issued shares, additional shares of $20,000. Okay, so that, if I want to show you that one, that's the journal entry. So you debit cash to record the cash that you raised from equity financing, and you issued common stock. Let me go one by one all the way to the end, see how it goes. So they have here, as you see, they have, but provide services to customers for cash, 35,000, and on account 30,000. To do that, you have cash received of 35,000, that's a debit, but the rest of the balance is on accounts receivable. That means we just waiting for the payment in future, and we recognize the revenue of $65,000 total, which is some of it is cash received, some of it is just accounts receivable. The next one, pay salary to employees for work in 2021. That's $23,000. So it's paid. So cash is paid, cash is credited out of your pocket, and then you record it as salary expense for $23,000. So far, so good. Purchase rental space for 1 year. $12,000. So $12,000 paid for renting space. So here is prepaid rent for 1 year, 12,000, and that's an asset, and cash is paid 12,000. And then the next one, purchase supplies on account. That means you didn't pay for it, $22,000, and that's an account. Here, supplies is recorded as an asset, and on account, that's accounts payable for $22,000 credit. You didn't pay for it yet. And the last one, pay dividend for $2,000, and that's how you record it. It says paid, so cash is credited because it's paid. Dividend is debited to recognize the dividend. Dividend is not an expense, but is form of distribution of portion of income to shareholders. And then if you go down, it says you need to recognize some adjustments at the end of the year. So let's see what type of adjustments we have. At the end of the December, employees are owed an additional $4,000 in salaries. So you're not going to pay it right now, but you need to recognize that there is such a liability. So here is the way do you recognize that there is a liability of $4,000. So that's a salaries expense, but since you didn't pay, it's a liability. That's a credit for $4,000. So far, so good. Okay, the next one, it says 3 months of rental space has expired. So you need to see when you pay for this. This is October 1st. So October, November, December, right? Even if it doesn't say 3 months of rent space has expired, this is babysitting, because I don't need someone to tell me that. I know already I paid for rent in October, right? And as an accountant, I know already that this October, November, December needs to be recognized. So I don't need someone to babysit and tell me this. But, and again, they told us, good to know. I didn't need to. Someone remind me. I know that. I am the accountant, and I need to know all those details. And by looking at that, I know. So, but anyway, at 3 months, someone told you here that it is expired. So 12,000 is for 1 year, divided by 12 months. It's $1,000 a month, right? So 3 months will be rent expense of $3,000 to recognize, and the asset will be reduced by $3,000. That's a credit. So prepaid rent will be reduced, expense will be increased. And that's where you were asking for. Adjusting entries. This is an adjusting entries to record the rent expense for $3,000 for the whatever happened that's incurred rent that you need to recognize. You deferred the rent recognition to future, right? So you paid for it and you deferred the recognition. Now it's time to recognize it. So when you are doing closing entries, that means any expense needs to be closed. Any revenue needs to be closed. Any dividend needs to be closed. And you start fresh. If you have any form of asset, let's say prepaid rent, then you take it with you to the next year. Any form of liability, you take it with you to the next year. You cannot close your asset or liability or equity, but you close your revenues, expenses, and the dividend for the year. So here is supply expense. Saying that you have supply expense of $5,000 on hand. So if you look in here, it says you have supplies of $8,000 at the beginning, and then you purchased supplies of $22,000. So beginning plus added, 8 plus added of 22, available is 30. 30 minus 5 left. That means 25 is used. That's BAASE, beginning, added, available, subtract, end. Beginning 22, beginning 8, added 22, available 30, end was 5, so used is 25. Here it is. And here is the math, and here is the journal entry. So supplies expense will be recognized for $25,000 that has been used, and supplies will be reduced. That's a credit by $25,000. The used part, you recognize it as an expense. The reduction in asset, this is where you reduce the asset by $25,000. So you reduce your asset by $25,000 to recognize the usage of supplies, which you call it supplies expense.
Okay, so yes, we used, okay, so the expense for all of the supplies currently is at $25,000. And then you reduce your asset, but with a credit at $25,000 also?
Yes,
Okay.
asset has a normal balance of debit, right? But if you credit your asset, then your asset will be reduced.
Okay, understood. Thank you.
Sure. Okay, and that was the rent expense that has been incurred for 3 months. That's why you need to recognize the rent expense. And again, reduce your asset by 30,000. The next thing is all of the services associated with the beginning deferred revenue have been performed. Okay, so unearned revenue has been performed completely. So here we have deferred revenue of $5,000, but the job is completed at the end of the year. So you get that information from the, let's say, operating management. Since his job is completed, your job is to recognize the revenue. So you close your liability, deferred revenue, that's a debit. Normal balance for liability is credit, but if you do debit, that means you close the liability. You reduce the liability. And normal balance for revenue is credit. So here you do credit for your revenue to recognize the revenue. And that's about it. Oh, no. And it says now prepare adjusted trial balance. So if you have done this on a paper using a T account, which normally I suggest. So if you do such a problem in here from this moment, when they gave you the account balances, you create all the T accounts, and then every single journal entry you did, you post it to the T account, and then every single adjusting entry you do, you post it to the T account. And since you post all these things to the T account on your paper, let's say you are doing this on paper, now you look at your T account balances, and then you create these adjusted trial balance. So as you see, adjusted trial balance, if you add them up on the debit side and on the credit side, should be equal at the end. And where is the numbers coming from? From your T account. You cannot get these numbers, or it will be very hard to get these numbers without a note paper with the T accounts on it and properly updated T account. Anyway, in case you want to prepare financial statement, you look at this area, revenue and expenses right there, and you create your income statement. The rest of the information over here that is not highlighted, they go into balance sheet. But before you create your balance sheet, you need statements of retained earning to know what the retained earning is at the updated version, because retained earning here is not updated yet, right? So you need to make sure that you create the statements of retained earning to update that. That means take care of dividend and retained earnings. So this portion will be in the statements of retained earning. So the first part is income statement. So that's what you take from revenues and expenses with the dollar sign and the double line dollar sign at the bottom, and to know what the net income is. Then you create your statements of retained earning, or if you like to do it very kind of complete, you do statements of stockholders' equity like this example. So in the stockholders' equity statement, you have a column for common stock and a column for retained earning. So it's more completed version of just having a statements of retained earning. So common stock was at the beginning 50, but you issued another $20,000 of worth of common stock. That means the common stock at the end of the balance is $70,000. Retained earning at the beginning was $25,000, but you had net income from here that goes there, and then minus dividend that you have in here, 2,000. And that gives you end retained earning. And then of course, if you add them up, total stockholders' equity will show up on the right column. Now, using this information, you prepare your balance sheet. Again, all assets and comes from here up to there. Right? Assets, that's your asset. That's your liability. And that's your equity. But retained earning, you cannot pick it up from here. You have to pick it up from there. So here we go. Assets. cash, receivable, supplies, prepaid rent. So prepaid rent, you seen before was 12,000, right? But now it's just 9,000 because you reduced it by 3,000. So total current asset that can be converted into cash within a year or less, that's current asset, that's $74,000. After current asset, we have short-term investment, which we don't have anything in this scenario. Skip. Third part of the asset is PP&E, property, plant, and equipment, which in this case is we have land. And that's all assets we have. After property, plant, and equipment, you have intangible assets. And then after intangible assets, you have other assets. Other assets are assets that you cannot categorize in one of the 4 categories above. So assets completely have 5 categories: current asset, long-term investment, property, plant, and equipment, like land, equipment, building, machineries, intangible assets, and category number 5 is other assets. Anyway, add them up. That's your total asset. $134 double line. Current liabilities are whatever you have in the trial balance, adjusted trial balance. That's $22,000 accounts payable. That's salary payable, and that gives you total liabilities. And those are current liabilities. They are not long-term. Liabilities, there are 2 categories in the classified balance sheet: current liabilities and long-term liabilities. Current liabilities are liabilities that you need to pay within a year or less. Long-term liabilities are liabilities that you pay longer than a year. We don't have any long-term liability here, so we skip it. Equity, common stock is $70,000, which you have that in here, and also the same information is right there in the adjusted trial balance. So you have that, but the equity comes from, retained earning comes from here, $38,000 from the retained earnings section of your stockholders' equity. So your retained earning at the end of the year is $38,000. Add them up, it's 108 total stockholders' equity, which is exactly equals to, as you see right there, 108. Okay, that's good. Now you add your liabilities plus your equity, and that gives you stockholders' equity plus liability of $134,000, double line dollar sign, and that's equals to your total asset. So that was something from chapter 3 that you were asking to go back and review. Closing entries, after financial statements are prepared, you close. What do you close? You close temporary accounts. What are the temporary accounts? Temporary accounts are dividend, revenue, and expense. Those are at the minimum temporary accounts that you have in this scenario: revenue, expense, and dividend. So in order to close those, let's see if it shows otherwise. So service revenue will be closed. It's a normal balance of credit, but you do debit to close it and put it in the retained earning. How do you get that 55,000? You don't know how much is it till, so you have to leave it blank for a second. And then you go ahead and add up all your expenses in here as a form of credit. Normal balance of any expense is debit, so you do credit opposite to close it. So you close all your expenses and then you add them up. After you add them up, that's where the addition goes. So equals to addition of all these cells, and that's 55,000. So you close the rent expense for 3,000. And then the last thing you close is the dividend. So dividend normal balance is a debit, so you do credit on the dividend to close it. Therefore, you do debit on the retained earning. And that's the last thing you close. Concern, individual project is coming, which is the same thing I just covered. Individual project is a company that has some transactions, and then at the end of the year, you have to do adjusting entries and then prepare financial statements. And then after financial statements are ready, then you do closing.
Okay. So I haven't opened it yet, Professor, but so we have to make our own company with our own information in it, or it already provides it?
No, it is a accounting cycle provided by Connect.
Okay.
Normally numbers will be changed for each student, so they don't get the same numbers over and over. So your project will be a little bit different than someone else's project.
Okay.
But overall, the idea is the same company's name. They might change it, I don't know, but dollars are different. But the idea is the same thing. Whatever I just did in last 15 minutes, 10 minutes, that was your project technically.
Okay. Got it.
So technically, I just did a project. In 15 minutes, I did a project. And your project will be something like this. All you need to know is they will give you, imagine here, this is exercise 3, number 20. This is something like your project. Your project says all this stuff, and it says, okay, do all these things.